If you're a tax practitioner, you have absolutely seen this happen. You have high-income clients, they're paying a ton for college, but their income is just too high to claim any of those education tax credits. The benefit? It just, poof, vanishes. But what if it doesn't have to? We're about to walk through a really powerful, and I mean powerful, regulation-based strategy. It's called the strategic forfeiture of a dependent, and yeah, it's a completely legitimate way to salvage those incredibly valuable credits.
So, here's our game plan. First, we're going to nail down the core problem, those MAGI limitations. Then, we'll dig into the specific Treasury regulation that cracks this whole thing open. After that, we'll do a step-by-step on how the student actually makes the claim, then navigate a huge potential snag, the Kiddie Tax, and finally, we'll wrap up with a break-even analysis to show you exactly what the payoff looks like.
All right, let's start at the beginning. We need to establish the fundamental challenge here. You know, the tax code gives us these great tools, like the American Opportunity and Lifetime Learning Credits, but then it puts up these statutory walls that just lock a lot of families out.
And this right here is the heart of the problem. It all comes down to Modified Adjusted Gross Income, or MAGI. Because of these really strict limitations, families that earn above a certain level get absolutely zero tax benefit for the tuition they're paying. They are completely 100% phased out, which means thousands of dollars in potential credits just disappear.
And when I say strict, I mean it. These phase-outs are just incredibly unforgiving. Just look at these 2025 thresholds. For a married couple filing jointly, the credits start to fade away at a MAGI of $160,000, and they are completely gone by $180,000. This isn't some gentle slope, you guys. It is a financial cliff.
And this number, this shows you exactly what's at stake. We're talking about the maximum American Opportunity Tax Credit, the AOTC. That's $2,500 per student per year. Now, if you have a family with 2 or 3 kids in college at the same time, that is a substantial amount of money to just leave on the table.
So the big question is, how do we get around this? Well, the solution isn't buried in some obscure loophole. Nope, it's written, plain as day, directly into the Treasury regulations that actually govern these very credits.
Which brings us to the pivotal question, right? Is that $2,500 credit just gone? An unavoidable casualty of having a high MAGI? Well, the answer, thankfully, is no. And the path forward comes from a very specific and really powerful regulatory provision.
This is it. This is the key to the whole kingdom right here. Treasury Regulation Section 1.25A-1F could not be clearer. It says that if a taxpayer, in our case, the parent, is eligible to claim the student but then chooses not to, the right to claim that credit shifts, and it shifts exclusively to the student. This is the legal foundation for this entire strategy.
See, what the regulation does is create this brilliant separation between two concepts. Eligible to be claimed, that's a legal status. It's based on the dependency tests in IRC Section 152. But actually claimed, that's a choice. It's an action the parent takes on their tax return. And by simply not taking that action, they unlock the student's ability to grab the credit for themselves.
Okay, so we've got the legal basis down. Now let's get into the nuts and bolts. How do we actually pull this off? How do we execute this strategic forfeiture to make sure it's going to hold up to any IRS scrutiny? Well, it's a very precise 4-step process.
The process itself is pretty straightforward. First, the parents simply choose not to claim the student as a dependent on their Form 1040. Easy enough. Second, and this is important, this means they are intentionally giving up the $500 credit for other dependents, or ODC. You can think of this as the cost of doing the strategy. Then, the student files their own tax return. And finally, on that return, the student fills out and files Form 8863 to claim the American Opportunity Tax Credit.
Now, the real action for the student happens on Part 3 of Form 8863. This is where the student formally lists themselves as the claimant. They put in their name, their social security number, their school's info, and then they have to go through a series of questions to prove that they, on their own, meet all the requirements for the AOTC.
Okay, so we've rescued the credit, we've shifted it to the student. Everything's great, right? Well, this is where the strategy gets really interesting and, honestly, a little bit perilous. See, making this move has a ripple effect. It triggers other, more complex sections of the tax code that you absolutely positively have to account for.
And let this be a crystal clear warning. By solving the parent's MAGI problem, we've just walked straight into a brand new problem on the student's return. This is that collateral consequence we have to carefully navigate.
So what's the big complication? It's the Kiddie Tax, which you calculate on Form 8615. This tax is designed to stop high-income parents from, say, shifting investment income over to their kids just to take advantage of their lower tax brackets. The risk is that by shifting the education credit, we might accidentally trip the wire for this very tax.
Here is exactly how the trap gets sprung. It's a chain reaction. First, under IRC Section 63C5, even though the parents didn't claim the student, the fact that they could have means the student's own standard deduction gets severely limited. It doesn't just pop back to the full amount. Second, to get the most out of the education credit, we often make some scholarship money taxable by allocating it to things like room and board. Well, that taxable scholarship income is treated as unearned income. So what happens? You've got this unearned income sitting on a tax return with a tiny standard deduction, and that's what triggers the Kiddie tax, which then gets calculated at the parents' much higher tax rates. It's a nasty little trap.
So this brings us to the final crucial step, the analysis. We've just created this Kiddie tax problem, right? But what's so elegant about this is that the strategy itself gives us the perfect tool to solve it, which lets us prove there's a real net financial benefit at the end of the day. And this is where it all comes together. It's beautiful, really. For most students under 24, IRC Section 1.25A-1 makes the AOTC a strictly non-refundable credit. Now, a non-refundable credit is pretty useless if you don't have any tax liability. But guess what? We just created a tax liability for the student, the Kiddie tax. So now, that non-refundable AOTC can be applied dollar for dollar to completely wipe out the very tax that this strategy created.
Let's just look at the raw numbers here. In Scenario A, the parents claim the student. Their net benefit is just that $500 dependent credit, and that's it. Now look over at Scenario B. Okay, the parents lose that $500, the student generates an $864 Kiddie tax, but their $2,500 AOTC wipes it out completely, leaving their final tax at zero. The total benefit created in this scenario is a tax shield worth $1,280.
So, here is the bottom line. When you compare the two scenarios, the family as a whole comes out ahead by $780. That's the $1,280 benefit from the student's credit minus the $500 credit the parents had to give up. This is real money, salvaged directly because of this strategic maneuver. So, the final question is, when does this actually make sense? The biggest takeaway here is that this is not an automatic win. It is highly situational. You have to model it out. It's most powerful when the student already has some unearned income that would get hit with the Kiddie tax anyway, or when you can create it with scholarship funds. Remember, without a tax liability on the student's return, that non-refundable AOTC is completely worthless. The final word of advice? Always run the numbers and prove the benefit before you file.